Welcome to the latest edition of Talking Data. Our Talking Data series seeks to offer timely insights into macro market themes along with macro data and its impact on the economy and markets. I'm Kristen Radosh of Arbor Research and Trading. As always, I will be your host today. Our presenters are Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. Today, our topic is our risk assets melting up. Ben, we're going to get started with you. And there's vaccines in the news, Yellen's appointment and rebounding Chinese growth, and they're all boosting bullish morale. Do you want to get us started with those topics?
Yes. So there's been kind of a confluence, everything's been stacking on top of each other now. With the vaccine news, of course, it began really with the Biden, kind of the decrease in election uncertainty. Now we get Yellen's appointment, we get the opportunity potentially for more fiscal assistance. And we're seeing some improvements, especially in East Asia on the industrial side and even on the consumer side that's starting to kind of bleed this way. And that's created this, high degree of euphoria within financial markets and really a melt up in asset prices. So we see the S&P 500's up, 62, 63% since its low. You have copper going parabolic. You have the majority of commodities now producing positive year-over-year gains. Even break-evens are starting to get in the mix a little bit. And so it feels like investor sentiment is getting overtly tipped. And one thing I'll make a quick comment and see what Jim thinks here too, is looking at FinTwit at like the 80 most prolific Twitter feeds. It's amazing how even the perma bears have flipped their tune on COVID-19 vaccines and have actually become bullish for the first time really in the past week or two. So really everyone's kind of going one direction now. And we are seeing somewhat of a melt up. It's a question of how much is that the volatility compression from the election, or how much of it is really, this euphoria over what could happen in the second half of next year. I know, Jim, you have definitely a different perspective in terms of the valuations and also really kind of the rockiness that we could see going forward over the next number of months due to COVID, is that right?
Yeah, I mean, first of all, I agree with you that, we've got the mad rush underway right now, that the game changer announcement has been all of the vaccine announcements. Every Monday we get another vaccine announcement, but it started 2 weeks ago with the Pfizer announcement, and everybody is running, basically in the risk assets. And the phrase I've heard is they're all living in the second half of 21, because you could make the case, in fact, I did in our piece this morning, you could make the case that the fourth quarter, first quarter are going to see some really challenging periods here with the lockdowns and with the COVID cases and with the struggles. And there's already mainstream Wall Street economists that are saying that between now and February, we could get 1 or 2 months of negative payroll growth. So we all have that expectation that that's coming, but we're living in the second half of 21. The concern that I have, and that's my job here, is to be the rain cloud in the party, is if you look at Wall Street estimates, whether you're talking about GDP or you're talking about earnings, the second half of the year since the vaccine announcements haven't gone up. They're not revising up their GDP forecast. They're not revising up their earnings forecast. They are, though, in the fourth quarter, first quarter, revising down those forecasts based on what they see. So the problem is you are currently at a very expensive market. And your bet here is that I'm going to buy very expensive stocks and watch them get even more expensive. Now, that'll work for the short term, next couple of weeks, few months, maybe several months. That could definitely work. But over the long term, I think if we're going to have a roaring 20s, which is kind of the battle cry that is more and more bubbling up, you're going to have to get rid of that expensiveness of stocks, because historically, you buy a 23, 25 PE on the S&P, and that's where we are right now. Over the next year, the correlations are random. Doesn't matter. Over the next 10 years, there's a better correlation, and that suggests low single-digit returns is what you could be looking for over the longer period of time. So the issue here, I think, is really, as you pointed out, the valuation issue is that we're not a cheap market at all as we move forward from here.
Yeah, and I think that too gets to, find this risk of the dark winter, is not really being priced in. And in one place you can see that for sure is, looking at the high yield corporate bond market. And for example, implied volatilities on HYG have now crashed on a 1 month basis to 7%, which is right on top of LQD, investment grade debt. So there's really, no outlook for solvency, liquidity issues going forward over the next number of months, even though some of these programs, 13.3 programs are going away at year end. And it feels like, the markets right now are priced for, like you said, this roaring 20s and not priced for any kind of hiccups in the market. So I think that the alternative data, high frequency data, be it home base or our own research activity, is confirming what you're talking about, Jim. The payrolls and the job market is going to have some kind of stumble over the next 1 to 3 months. I think there's a very high likelihood of that. And investors have to remember, we've been living really since June or so on just nothing but fantastic economic data. And there's been really no wobbles. If you string all them all together, nothing but an upward, nice sloping line. Yes, the surprise indices have come down a bit, but we haven't seen investors have to react to really negative news. So I think that's going to be, we'll find out if the markets are willing to price in some of these potential hiccups and bumps in the road. Maybe it'll be this month for November's payroll numbers. I know there's some that are forecasting some weaker numbers, but I think that right now the thing that gets me most concerned is the lack of implied volatility, or really heightened volatility anywhere. Yes, a little bit in the VIX in the long end of the curve, but especially credit markets, they're priced for really for perfection, which does make me nervous.
Yeah, we talked about this offline, Ben and I, yesterday, but a lot of these financial conditions indexes, especially the Goldman index, are at all-time lows, meaning that financial conditions have never been easier. It's never been easier to be in the market than right now. Now, I know, Ben, you agree with me when we talked about it. I don't know what the value is of these indexes. I think they kind of tell you, they kind of nowcast and they state the obvious as to what's happening now, but they don't have much predictive value about what's going to happen next. But nevertheless, they are saying that things are very, very easy right now, and that they're going to continue to stay that way, at least for the very short term. Now, circumstances can intervene and can change that. And the other thing is the Federal Reserve. The Yellen announcement, and I need to remind Wall Street, Yellen was not appointed Federal Reserve Chairman, because the way that everybody is describing this, she wasn't appointed Federal Reserve Chairman. She was actually appointed Treasury Secretary. Last I checked, that's a different job. But whenever I literally was watching people talk about her grasp of ISLM and stuff like that. I was like, but she's Treasury Secretary. You don't need to even know what those letters mean in order to be Treasury Secretary as well. And so, but nevertheless, with her at the Treasury, with the Fed's new announcement that they're going to favor employment over inflation, there is also a belief that if there is a dark winter, if there is a stumble in the payrolls, don't worry, Jay and his magical printing machine, backed up by Janet over at the Treasury Department, they will get us through the winter until we get to the second half of 21 when the vaccine comes. So that's the other hope as well too. And as I've said in virtually every one of these podcasts, that works, and it works well unless you get inflation. And if you get inflation, then it becomes problematic. And then I still think that inflation is not evident today, but I think it will be evident by second half of 21, that you will see some kind of a move in inflation and a move higher in inflation. So that whole idea that we could just print our way through all the valleys waiting for the vaccine in order to get to the high, that can work for a while, but I don't think it can work permanently.
Yeah, and so you and I, Jim, have disagreed on the short-term outlook, and I guess medium-term outlook too on inflation a little bit, not a lot, but a little bit. But it seems like things are kind of going actually, more your direction here, in that we're seeing this commodities reflation. We're beginning to see break evens perk up, and the probability of 2+% headline inflation. And to confirm that, what we're seeing is implied volatility, which yes is low on the S&P 500, but the VIX is all of a sudden lost that negative correlation to TIPS break evens. Which I think is actually really interesting. That doesn't happen often. That's, again, like we talked last time we were talking, that it occurred back in Volmageddon. But if we can get an appreciably positive correlation there, looking at a rolling 30 or 60-day correlation, what the scenario you just said, or just we're speaking about, is one that becomes more important sooner than later. And so I think that's something investors really need to watch. That is one of the big risks. One of our bullet points here, I think, going forward, I'm starting to become more and more of a believer that we got to be more focused on that risk before I was just kind of, brush it off and laugh at the at inflation. But keep an eye on that VIX and break evens, and also 30-year break evens at 186 basis points, pushing above 190, which is usually a critical level, would be somewhat of a big deal for the break-even inflation expectation market.
And let me finish up this section by asking you a question out of left field. You talked about the 30-year, breaking 190. The 2 years breaking out. The 2-year break-evens are breaking out right now. They just took out their March 6th high today, the day we're speaking, and they're about at the highest levels they've been through, basically 2020. They're around 153 or so. That's a long way from the minus 90 basis points they were back in March as well. Do you put any predictive value on the very short end break evens, or do you think it's more important if we focus on the longer end ones?
Well, so usually I say, don't deal with the noise, especially with crude oil built into the very short-term break evens. But I think there's some interesting developments happening there with the nominal 2-year kind of stuck just going sideways. What's happening is we're getting all of a sudden a break in the positive correlation between the nominal and the tip yield, which doesn't happen often. And that means that real yields, the 2-year yields are plummeting, while the nominals are remaining the same, as we get this belief that maybe there's something to this inflation story, as well as especially with crude oil coming up. So I think that this floor that investors have put in place from really looking 5 years on out for CPI, right around 1.5% year over year, is getting pulled in a little bit now to that 2-year space. And like you just said, 150 basis points. We've loved buying TIPS break evens 150 basis points because that's been a nice firm floor. If 2 years are now getting that same floor, that becomes interesting, because that means then that this inflation dynamic and story could be becoming more front and center faster than people realize. So usually I say forget it, but in this case, I think you got to pay attention to what happens to that outlook for the next 2 years.
Interesting. Kristen, next question.
Why haven't U.S. Treasury yields fully joined the risk-on storyline?
I'll start with that. I think the biggest thing about Treasury yields, you're right. They kind of flirted with 97 basis points about a week and a half ago, and now we're down around 88 basis points. I'm talking about the 10-year note as well. I think that the big problem here is that you got to remember that the biggest player in that space is the Fed. The Fed has been a big buyer on the long end. There's talk that they might, in the December meeting, extend the maturities of their QE. They're buying 120 billion a month, 80 billion in treasuries, 40 billion in mortgages. And by extending the maturities, they'll just buy more 10-year notes and less 2-year notes along those lines as well too. And I think that they've been helping to basically put a ceiling on those rates. There's also the fear or the talk that yield curve control could be behind the next corner as well too. And then finally, with a lot of these 13.3 programs going away because the Treasury wants to cancel them, there's a belief that there's a heightened chance the Fed might increase its QE as we move forward from here. So I think that there's one part of it is on the Fed. The other part of it is, I know Ben's going to talk about this too, is that what has been one of the staples over the last decade is bond yields get right on the point of breaking out and then they do nothing. Mm-hmm. And that's been kind of the measure that tells you that maybe they're not quite ready for that big up leg right now. And that could be very well the case. Maybe it's still months off before we see that up leg, but it might be not right now. Ben, how about that? We were about ready to break out, and we've seen this move so many times in the last 10 years. And then
we have. Exactly. And so for me, the treasuries too, treasury market has become kind of the forgotten asset class. So investors on an ETF basis have just kind of forgotten it. The flows have come on a little bit to the long end, based on when people go into risk assets, they're also going to be buying bonds with the 60-40 portfolios and so on. Some of that we've seen kind of shift already a little bit. But on whole, investors have really actually not done anything, or they've sold treasuries across the entire curve. I don't care if it's 1 to 3 years or it's the 20 to 30 year maturities. And typically when that happens, you get everybody to be kind of ho hum and sell treasuries. It kind of is an exhaust sign and signal. So I think I agree with you, Jim. Yields are going to eventually be going higher here based on all the dynamics of fiscal policy, monetary policy, and now potentially the growth we'll see. But I think there might be one last opportunity over the next couple of months for sellers to find better prices, higher prices, lower yields to book. So again, if you look back at post-crisis periods when on a rolling 3-month basis, everyone has sold ETFs, treasury ETFs across the entire curve, 10-year yields typically fall somewhere around 30 to maybe 35, 40 basis points over the next number of months, 2.5 months. I don't think it'll go that far, that much, but I wouldn't be surprised to see some kind of kind of relief rally. Maybe be helped by the Fed, like you said, with either yield curve control or pushing extending maturity purchases. But I agree. I don't think the rip-roaring rise in yields is necessarily here right now, unless we got that intense inflation storyline to go.
Yeah, we're not there yet, and we'll see whether or not it does evolve. As I've joked, and I'm not trying to be two-faced about it, but I say that 2021 is going to be the story of inflation. Either we get it, and then we say, look, all the stimulus and everything else was too much, and we produced inflation, or we don't. And then, as I like to joke, Stephanie Kelton wins, and we're now in a new era of $3 trillion deficits and massive pump priming and all of that other stimulus and government involvement in the financial sector and in the economy, because it works. It works without producing an adverse outcome. So like I said, inflation, I think, is the story of 21, whichever side we get it, because we're going to be in a whole new regime if we don't get inflation, considering what we've been doing during the pandemic. Kristen, how about our last question?
Well, that's really it for questions. I just wanted to see if you guys had any follow-up comments and summary for today.
Ben, did you want to go first, or yeah?
Sure, I can go quick. Yeah. So I think that it's hard to refute that we're getting a melt up here in risk assets. But part of me thinks some of this could still be the volatility, compression we saw from the election, helping fuel the rebound. The only thing that's kind of more interesting, it is happening kind of ubiquitously. We are seeing copper, all major commodities, break evens, yields, equities, flourish. And I am getting a little concerned about the euphoria, especially with the sentiment data that we track via, FinTwit or even news trends. So I think that bears some close watching. I think also we will see somewhat of a hiccup with some of the econ data, either for November or December. Nothing horrible, but it'll be the first hiccup that we've seen really in months since the pandemic hit. And that will really show investors wherewithal. And maybe we'll get a little bit of some kind of reaction, especially in the applied volatility front. I think there's going to be some opportunities there, especially in the high yield space with HYG conversion with LQD. So we'll have to wait and see. There's still so much unknown here over the next couple months with COVID. So I think uncertainty is a little bit higher than people give it credit for.
I'll underscore that idea about that. There's definitely a speculative froth that seems to be developing. Now I've said that doesn't mean that it's going to end 20 minutes after we're done talking. It can go for a couple more days. It could go for several more months. But there's definitely a speculative froth. And one of the signs you might be seeing that speculative froth is in the cryptos. Bitcoin's over 19,000. The last time the all-time high in Bitcoin is only a few $100s higher from where the price is right now. That was December of 17. And what do we know about the markets? They were roaring right into the February of 8 or late January, early February 18 peak, which, as Ben talked about, was Volmageddon, when the markets just completely melted down into February and into March of 2018, and volatility spiked from 12.5 to 50 in a couple of days. That's the VIX index spiked that much and blew up a bunch of ETFs and everything else. But one of the signs that you were definitely in a speculative froth back then was the cryptos were roaring along with the stock market. Well, that's what's happening now. That doesn't mean that Volmageddon version 2 happens Friday or next Monday. It could still be many months away, still be a couple of weeks away or so. But make no mistake, we are definitely in the throes of some kind of a melt up going on in this market. Everybody's grabbing because everybody's got their big story. They've got the vaccine, return to normal. What's not to like about this? It's all going to be okay. So buy anything with a bid, and then except for gold. Poor gold is the only exception to the rule. It doesn't seem to want to do anything right now. But short of that, everything else seems to be going as well.
Thank you, Jim. Thank you, Ben, for your thoughts today. We really appreciate it. Thank you for our audience for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent research offerings are Bianco Research and Arbor Data Science. For further information on Arbor Research, Bianco Research, and Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com.